Tonight I'm going to talk to you about this book, The Little Book of Common Sense Investing by John C. Bogle. I'm going to do this video slightly different than some of my other ones, but you'll see as I go. John Bogle was this guy here. He lived to be 89 years old. He was an investor, and he created this investment group called the Vanguard Group. And he's also credited with creating the first index fund, and that's basically what this book is all about, is index funds. There are other points that he covers, but it has a lot to do with index funds. So what I'm going to do is I'm going to comment on this video as it goes along. I will interrupt quite a bit, but I just want to do something a little different this time.
John Bogle states the importance of owning an index fund and how it is far superior to most actively managed funds, that the average investor has a high chance of success in investing if you just buy the haystack instead of trying to find the needle in it. In this video, I will talk about the best lessons I've learned from the book The Little Book of Common Sense by John Bogle. The first lesson: instead of looking for the needle in the haystack, just buy the haystack.
And that's what an index fund is. It is the haystack. Here, let's go back to what are index funds. This was from Investopedia. Let's see, Investopedia.com. I think it's a great source. All right, so an index fund is a type of mutual fund or ETF with a portfolio constructed to match or track the components of a financial market index, such as the S&P 500. An index mutual fund provides broad market exposure, low operating expenses, and low portfolio turnover. That's the most important part of this definition. A mutual fund gives you broad market exposure because you are buying into several different companies and in several different sectors. And there's low operating expenses because you're not trading. Stock trading becomes expensive because you're always being taxed and you're paying all kinds of fees to the stockbroker. But this index fund is a lot cheaper to maintain.
The haystack is the index fund. It is simply a basket or portfolio that holds many eggs, which is stocks, designed to mimic the overall performance of any financial market or sector. By investing in an index fund, this already eliminates the risk of individual stocks, market sectors, and manager selection. The only risk that remains is stock market risk, because you don't need to find each good individual companies to invest in. You don't need to be afraid if one sector falls, like one that happened in 2000 from the tech bubble, or if the real estate market falls down. Since you already hold different stocks over different sectors, by owning just one fund, you are completely diversified.
And that's the key, diversification. Like he just mentioned, the tech bubble of the 90s, that was the internet stocks. And there was also the real estate bubble of 2008, I believe. So if you are investing in an index fund, you're not totally immune to the stock market risks, but at the same time, you're not going to lose everything. You might lose a little bit in the real estate bubble or the tech bubble, but you can also make a lot of money in those bubbles as well. But he doesn't mention that.
Simply put, common sense investing tells us the winning strategy is to own all of the nation's publicly held businesses at a very low cost. By doing so, you are guaranteed to capture almost the entire return that they generate in the form of dividends and earnings growth. The second lesson: long-term is the best way to go. John Bogle states that the stock market is a giant distraction, that causes investors to focus on transitory and volatile investment expectations rather than on what is really important, which is the gradual accumulation of the returns earned by corporate business. He advises to us investors to ignore the short-term noise of the emotions reflected in our financial markets and focus on the productive long-term economics of corporate businesses. This was actually described by Benjamin Graham, the mentor of Warren Buffett, in his book, The Intelligent Investor.
Long term is really where it's at. It's safer and you will make more money in the long run. Short term, like trading, you can make some money, but you can lose a lot of money too. And then you have to consider all the fees that go to brokers and taxes.
In the short run, the stock market is a voting machine, but in the long run, it is a weighing machine. He even calls it by a name, Mr. Market. Now, Mr. Market is the one selling us stocks on a day-to-day basis and is quite emotional. So this means, as an investor with a portfolio of sound stocks, you should expect their prices to fluctuate and should neither be concerned by these declines nor become excited by sudden advances.
See, ignore the noise. The bubbles are noise. I think there was also a Bitcoin bubble as well. So those bubbles, they stir up emotions. A lot of people get emotional about them. And they think that these bubbles are never going to burst, but they always do. The stock market goes up, the stock market goes down, bubbles burst. So if you can ignore the noise, you can survive those bubbles and not put all of your money into a stock or something. There's an example of pets.com. A lot of people sunk a lot of money into that and it just burst. There were others as well, but I'm just using that as an example.
Always remember that market quotations are there either to be taken advantage of or to be ignored. That's it. Don't listen to what Mr. Market is offering on a daily basis. These are all noise. And since we are holding an index fund, the more we don't need to care about these fluctuations, since what we only need to do is to invest regularly and hold it for a very long time. If possible, forever. It's that easy. Third, don't allow a winner's game to be a losing game. I think you may have heard of Einstein's statement that the eighth wonder of the world is compounding interest. He who understands it earns it, and he who doesn't pays for it. In stocks, the wonderful magic of compounding returns is reflected in the long-term productivity of businesses, then is translated into equally wonderful returns in the stock market. But those returns are overwhelmed by the powerful compounding force of the cost of investing. John Bogle said, "For those who choose to play the game, the odds in favor of the successful achievement of superior returns are terrible. By simply playing the game, consigns the average investor to a shortfall in the returns generated by the stock market."
Let me go back just a moment to compound interest. According to Forbes Advisor, compound interest means you're not just earning interest on your principal balance. So let's say if you have $1,000 in the bank, that's your principal. You are earning interest on that principal. So even if your interest earns interest on your principal, compound interest is when you add the earned interest back into your balance. So the interest you get from your $1,000, you just reinvest it. And you do this over and over and over. And you compound your interest. So like it says here, let's say you have $1,000 in a savings account that earns 5% in annual interest. In year one, you'd earn $50, giving you a new balance of $1,050. In year two, you would earn 5% on the larger balance, which is $5,250, giving you a new balance of $1,102.50 at the end of year 2. So you see how it works? You just keep reinvesting. You don't cash out.
Over the long term, the game we are talking about is investing actively, actively trading, actively buying and selling stocks in the short term rather than focusing on the long hold. This is a game a lot of investors play. Most investors think that doing a lot of things is the best way to go to earn more in the market. And this is also what businesses use to persuade their clients. They say, don't just stand there, do something. But in reality, what works in the stock market is, don't do something, just stand there. This is to avoid playing the loser's game. Now this was well explained by the statement of the legendary investor himself, Warren Buffett. Returns decrease as motion increases, because a higher level of investment activity, the greater the cost of financial intermediation and taxes.
All right, so I want to take you to the fees that the author is talking about in this book. This is a summary of the book. I mean, I thought it was okay, but there's a few things that I thought were most important. There's the expense ratio. These are management fees and operating expenses. There's the cost of portfolio turnover. And portfolio turnover is defined as the percentage of a portfolio that has been replaced in a given year. And there's also the transaction costs. There's taxes. You see, these are the expenses he's talking about.
Just think of it this way. The more you buy and sell, the higher your fees or costs are, which means for us, higher costs means lower gains. Our goal as an investor is to lower costs as much as possible, which means higher gains for us, letting us use compounding in favor of us. Fees are a hindrance to long-term gain. This is also one of the reasons why a lot of actively managed funds underperform the index. By actively buying and selling stocks, active funds incur unnecessary taxes and fees. And you know, the worst thing about this, the fees usually come out of the pocket of its investors. Such funds charge higher fees while underperforming the index. Imagine, you are actually paying them more to underperform the benchmark. And this jumps us to the next lesson.
See, it's like a casino. The house always wins, and the hedge funds win, the stockbrokers win. You may lose, but they always win.
I've learned. Fourth, consistency and compounding. Although some actively managed funds do beat the index, but only a few of them exist, and it's difficult to find. And even if you find one, it's not guaranteed that it will continue its good performance, since a lot of factors play. One such is a successful manager can retire or quit anytime, and most mutual funds change their stock picks most of the time, incurring unnecessary taxes, and sometimes the stocks they pick don't often do well, which leads to another reshuffling, since they need to satisfy their investors, unlike an index fund that stays consistent for a long period. Remember, consistency matters. A fund that is good or very good in the vast majority of years produces a far larger long-term return than a fund that is superb in half the years and a disaster in the remaining. And what some funds do is just tell investors the gross return of their fund. But in reality, after all the fees and taxes involved, the net return for its investors would be far less. Most investors take this for granted, since it is hidden from view. Remember, fees also compound over a long time, and this applies to actively managed mutual funds. I think you heard the saying that in the stock market,
if something is actively managed, it's going to cost you. If you put your money in something for the long term, it's not actively managed, it's not going to cost you that much in the long run.
time is very important for compounding to work. So to put it, where returns are concerned, time is your friend. But where costs are concerned, like the higher fees that actively managed funds charge you on a year-to-year basis, time is your enemy, as it also compounds over time. So for common sense investing, successful investing is about owning businesses and reaping the huge rewards of dividends and earnings growth for a long time while maintaining costs as low as possible. That is what indexing is about. It doesn't shuffle investments like what managers do, and it doesn't charge you higher fees because it doesn't need a manager to actively pick stocks. So less activity, less fees, bigger gains.
See? Less activity, less fees. That's very important to know.
For us investors. This lets compounding return working for us instead of against us. Lastly, take emotions out. For index fund investing, emotions would just be a hindrance to you. Now, this is also applicable to any form of strategy you use in investing. Take emotions out. Fund investors usually look for the hot trending investment, letting their greed take control. Sadly, this is also what the fund industry itself has used. They bring out new funds to meet the fads and fashions of the day, often supercharged and speculative, and aggressively advertising and marketing them. John Bogle described it, whenever counterproductive investor emotions are played on by ever counterproductive fund industry promotions, little good is apt to result. So as an intelligent investor, you better not heed the call.
See, that's how bubbles become bigger. Emotions. These people, usually men, I guess, get emotional about a stock and they lose a lot. They either lose everything or if they were to ride the bubble and invest a certain amount of money and then cash out early, they would beat the bubble. But many of them don't. They let their emotions get in the way. They don't think the bubble's ever going to end, and it usually does.
Don't let your emotions take control of your decisions. This is the best thing about index funds. Not only is it low on expenses, but it also eliminates those tempting fund choices that promise so much and deliver so little. And index funds can be held through thick and thin for an investment lifetime, so emotions need never enter the equation. Warren Buffett summarized this for us in what John Bogle called the 4 E's. The greatest enemies of the equity investor are expenses and emotion.
See, the greatest enemies of the equity investor are expenses and emotions. This is true. The expenses are the management fees, taxes, and so forth. And then emotions. Emotions are greed is one of them, fear of missing out, and so forth.
So better remember that. So with that, this ends this video for...
I had some things prepared, but then I thought, well, I'll try something different. I'll just use this video and comment on it.
Index funds are the best option for most investors out there, especially for those who doesn't have time or knowledge to analyze individual stocks. The strategy for it is a no-brainer. Just buy the haystack consistently over different time frames and hold it for a long time. If you can, forever. So I hope you've learned something.
I am continually learning about the stock market, about mutual funds, indexes, and so forth. I have a long way to go before I'm proficient enough to really become a good investor. So I hope this video helped you. I hope that I explained things well. You can always go to this site, investopedia.com. It's a great source of information if you're interested in the financial market. Anyway, that's all I got. Talk to you later. Bye.